So the S&P 500 is on an absolute tear, hitting new records left and right. And for investors, that's both exciting and, let's be honest, kind of terrifying. It really brings up two huge questions that we all need to think about before making our next move.
So we're going to tackle these two big questions head-on. First, with the market at an all-time high, should you even be thinking about buying in, or is it smarter to wait on the sidelines for a drop? And second, there's a pretty famous doomsday indicator that's flashing its highest reading in history. I mean, is some kind of apocalyptic crash really just around the corner?
All right, here's our game plan for this explainer. We're going to deconstruct these fears. We'll look at what the data actually says about investing at market peaks. Then we'll dive into that famous doomsday indicator and explore why its warnings might be totally outdated for today's economy. And finally, we'll look at a different path forward.
Okay, let's jump right into that first big fear. The idea that buying when the market is at its absolute peak is a classic rookie mistake. You know, the logic feels right. What goes up must come down. But what are the facts? What does the data actually tell us? Well, take a look at this. This chart pretty much flips that whole idea on its head. It shows the average one-year return for the S&P 500. See that first bar? That's your return if you bought on a day the market hit a brand new high. The second bar? That's your return if you bought on any other random day. As you can see, the difference is, well, it's tiny.
So the data is telling us that trying to time the market by dodging all-time highs doesn't really give you much of an edge. So if that's not the secret sauce, then what's the real underlying force that keeps pushing markets higher over the long haul?
And that brings us to this monster of a concept, monetary degradation. It sounds complicated, but it's not. Just think about it this way. $1 today buys you way less coffee, less gas, fewer groceries than it did 10 years ago. That's monetary degradation. And it is a huge reason why asset prices, like stocks, tend to climb over time. It's not just that they're getting more valuable, the money itself is just worth less.
So here's the crucial takeaway. Instead of being afraid of all-time highs, a smarter approach is to look for opportunities within the long-term trend. You know, historically, the market usually has one or two pretty big pullbacks of 10% or more each year. Those are the moments when fear is running high, the headlines are all doom and gloom, and that's when the big players often step in and buy things up. The strategy is to use those dips to build your positions, letting that powerful long-term force of monetary degradation do the heavy lifting for you.
So, if buying at all-time highs isn't the big boogeyman people think it is, what about other warning signs? Well, that brings us to our second big question, and this famous doomsday indicator that a lot of people are pointing to as proof of an impending apocalyptic crash. 277%. Right now, that is the reading on what's known as the Buffett indicator. And to be crystal clear, it has never, ever been this high. So you can see why this has some people absolutely convinced we're at a top and headed for a deep, painful fall. So what is this thing? Well, the indicator got famous thanks to Warren Buffett way back in 2001, and it's a really simple ratio. You just take the total value of the entire U.S. stock market, all of it, and divide it by the country's gross domestic product, or GDP. The thinking is, if the stock market's value is growing way, way faster than the actual economy that's supposed to support it, then stocks are probably overvalued and due for a big correction. But, and this is a huge but, here's the counter-argument. Using a metric from 2001 to measure the economy we have today, that's kind of like using a map from the horse and buggy era to navigate a superhighway in a self-driving car. The world has just fundamentally changed.
Think about it. Back in 2001, the U.S. economy was much more self-contained, and it was driven by things like manufacturing. Fast forward to today, and we're in a globalized, tech-driven world. I mean, just look at the Magnificent Seven. These massive companies make up a huge chunk of the S&P 500, and they get roughly half of their revenue from outside the United States. They scale globally using data, software, and AI, which just wasn't the case back then.
All right, let's break down the 4 key reasons this famous indicator might just be broken. First, global earnings. The indicator compares the market cap, which includes all those global profits, to only U.S. GDP. That's a serious apples to oranges comparison. Second, the economic shift we just talked about. Third, interest rates. Rates were around 6% back in 2001. They're much, much lower now. And when rates are low, future company profits are worth more today, which justifies higher stock prices. And finally, we come right back to our old friend, monetary degradation. All the government spending and debt has put that into overdrive, which devalues the currency and makes the GDP number in the denominator artificially smaller, making that ratio look even scarier than it is. Okay, so if we can set aside the fear of buying at all-time highs, and we can question the warnings from what might be a totally obsolete indicator, what does the path forward actually look like? Well, the core conclusion from this analysis is not one of doom and gloom, but actually one of growth. The forecast here isn't for an apocalyptic fall, but for an acceleration in the global economy.
And what's going to fuel this growth? Well, it really comes down to a few key drivers. We're seeing strong private consumption, continued high levels of public spending, and of course, that relentless, unstoppable force of monetary degradation. All of these things are expected to keep pushing asset prices higher, with this trend possibly lasting well into 2026 and 2027.
So at the end of the day, the big picture here is that while those fears of a crash are totally understandable, the underlying forces of strong economic growth and steady currency devaluation are just incredibly powerful, and they are expected to keep driving markets upward.
And all of this leaves us with one final and really crucial question. If the classic indicators that investors have leaned on for decades are becoming obsolete in this new economy, what are the new signals and metrics we should all be watching? Now, that's a topic for another day, but it's a question every single investor needs to be asking to really understand where the market is headed next.